Welcome to the True P&L Deep Dive. Before we start, a quick disclaimer. This analysis is for educational purposes only and does not constitute financial advice. Always do your own research. Now, let's get into the numbers.
All right, let's do it.
Our mission today is, well, it's pretty laser-focused. We're looking at the Bukit Darah PLC, or BUKI, 1H FY26 financial report.
And we're not just reading the summary. Our goal is to find what we call the true P&L.
Exactly. We need to get past the headline figures and really confirm the quality, the sustainability of these numbers that, frankly, caused a bit of a stir.
Yeah, we're not here for a simple earnings recap. We're putting on our forensic analyst hats. Is this profit high-octane fuel for future growth, or is it, diluted with a bunch of one-off accounting tricks?
And there's a huge hook right out of the gate, the number that makes everyone just stop and pause.
Oh, yeah, the big one.
Profit attributable to equity holders.
Yeah.
It just exploded. We're talking surge of 165% year over year.
It's a stunning number. From what, about 3.86 billion rupees to 10.22 billion.
165%. I mean, for a mature conglomerate of this scale, to see that kind of growth in just 6 months is, well, almost unheard of.
It is, and that's why we have to ask the big question right up front before we even touch the operations.
Is it real?
Is this monumental jump the result of genuine underlying business strength? Or is it just some accounting timing, or maybe, and this is a big one, a reversal of some massive headwind from last year that's just artificially inflating the comparison? That 165% number, that's where our skepticism has to start.
Okay, so let's start there. Let's unpack this with what you call the cleanup crew.
Exactly. We need to look at the non-core items, the noise that can inflate the profit before tax, the PBT. To find the true P&L, we have to stress test the quality of that 10.22 billion rupee figure.
Meaning we strip out anything that isn't from their core business selling palm oil, beverages, that kind of thing.
Precisely. And to do that, we start with the usual suspects. First up, fair value gains.
Okay.
The report shows about 3.08 billion rupees in fair value gains for the period.
Which is a substantial number. I mean, compared to last year's 346 million, it's a huge jump.
It is, but we need context. 3.08 billion is a lot of money, no doubt. If that number made up, say, 70 or 80% of the entire profit before tax,
we'd have a huge problem. We'd be raising serious red flags about the quality of this profit.
Because fair value gains, things like revaluing investment properties or their plantations, they're inherently non-cash. They're not operational. They can, evaporate just as quickly as they appear.
Right, they depend on market whims.
But this is where the deeper analysis comes in. We have to isolate these gains. So we do the math. We take that 3.08 billion rupee gain and divide it by the total profit before tax.
And what do we get?
We find that these gains, despite how big they look on their own, only represent about 9% of the total PBT.
Okay, now that is a critical distinction.
It's huge. It gives us a lot of comfort right away. It confirms that the vast majority, over 90% of their pre-tax profit, is coming from actual operational business activities.
So from selling CPO, bottling drinks, running their plants.
Yes. For a conglomerate with this many assets, seeing less than 10% of profit driven by volatile, non-cash gains is a really powerful green flag. It speaks to the quality of the core operation.
So the core business is doing the heavy lifting. That's exactly what you want to see, but that's not the only piece of the noise, is it?
Not at all. The second major non-operating item we have to talk about is the foreign exchange, or FX swing. And this is absolutely crucial for understanding that 165% growth number.
Yeah, yes. This is the part that can really create an optical illusion.
Without a doubt. The FX movement is probably the single biggest reason why that year-over-year growth looks so massively inflated.
Okay, so what are the numbers?
In this period, 1H FY26, the company recorded a small positive FX gain of 166 million rupees.
Which seems pretty insignificant on its own.
It does, until you compare it to what happened last year. In the same period last year, they recorded a substantial FX loss of 1.34 billion rupees.
Wow. Okay, so that's not just a gain versus a loss.
It's a swing of about 1.5 billion rupees on the P&L. It went from being a major drag on earnings last year to a tiny little boost this year.
And that creates a massive tailwind for the comparison.
An enormous tailwind. It means the base number we're comparing against, that 3.86 billion in profit from last year, was artificially pushed down by that huge FX loss.
Right. The prior year's results were suppressed. It's like they were running a race with an anchor tied to their leg.
Perfect analogy. This year's result is strong on its own for sure, but it gets a huge lift just from the fact that they didn't have that anchor dragging them down again.
So to be clear, if we were to strip out the FX noise from both years, the operational growth would still be very impressive, but it would be nowhere near 165%.
Exactly. Their operations grew strongly, and they removed a major headwind. The 165% is really just an optical illusion created by that depressed base from last year.
Okay, so let's try to put an initial verdict on the quality here.
Yeah.
The headline number, while definitely boosted by that comparison and slightly helped by fair value gains, seems to be fundamentally sound.
I agree with that. The core operations look strong because the profit isn't, overwhelmingly reliant on these non-operating items. That 9% contribution from fair value gains is the key. It tells us the engine is running cleanly.
So I've done the quality check. We've confirmed the earnings are mostly clean. Now, this forces us to go deeper.
Yeah.
If the 165% number is misleading, what is the real engine doing? Where is this operational growth actually coming from?
Well, now we move from the cleanup crew into the operational health. This is where we shift from the bottom line to the actual mechanics of the income statement.
Right. And the real sign of efficiency isn't just revenue growth.
No, it's the divergence, the gap between how fast revenue is growing and how fast profit margins are growing. That divergence tells you everything about management effectiveness.
So if a company just grows revenue, it could just be selling more stuff at the same old margin. But here,
the story is much more encouraging. Revenue was up a solid 17% year over year, hitting $175.36 billion. That's healthy. But gross profit surged 31% to $49.39 billion. And even more critically, operating profit jumped 62% to $32.95 billion.
a 62% jump in operating profit on only 17% revenue growth. That's a huge gap.
It's a massive gap. And it screams aggressive margin expansion. It tells us they're not just selling more volume, they are managing their costs, both the cost of goods and their operating expenses, far more effectively than they were a year ago.
So they're getting more profit from every single rupee of revenue that comes in the door.
That's it. It points to significant operating leverage in the business model. For every new rupee of revenue they bring in, a much larger chunk of it is flowing straight down to the operating line.
Which is the holy grail for a big conglomerate like this. It means they either have fantastic pricing power or they're just incredibly disciplined on costs. Or both.
Or both. And the numbers really back this up. Let's get into the weeds on the margin figures because they're the core metric here.
Go for it.
Last year, the gross margin, so that's profit after the direct cost of goods, was 25.08%. This year, it rose to 28.17%.
That's a big jump, over 300 basis points. That's serious improvement right at the top of the P&L.
And that improved gross margin feeds directly down into the most important line for operational health, the operating margin.
And what did that do?
It jumped from 13.56% last year to 18.79% this year. That is a massive 523 basis point expansion.
Wow. Over 500 basis points in 6 months for a company this size is monumental. It suggests really extraordinary control over their SG&A expenses. They're getting leaner as they're getting bigger.
Exactly. And all of that efficiency ultimately filters down to the net profit margin. That more than doubled from 2.58% to 5.83%.
Doubling your net profitability per rupee of revenue, that's a huge competitive shift.
It is. And it begs the question, where is this coming from? So we have to do the sectoral deep dive. We need to see which of their three main pillars is carrying the most weight.
Let's do it.
Okay, the primary profit engine, without a doubt, is still the oil palm plantations. Revenue up 19% to nearly 65 billion rupees. And it generated a massive PBT of 18.29 billion.
So that one segment is almost half the group's operational profit.
A huge chunk of it. And the report attributes this to two things. First, higher crude palm oil, or CPO, prices. So pricing power from the market.
Okay, a market tailwind.
Right. But second, it also cites internal production efficiencies. So they're getting strong prices, and they're getting better at their core job on the ground. Improving yields, optimizing harvesting. That combination is incredibly potent.
It suggests the strength is structural, not just luck from the commodity cycle.
I think so. Okay, pillar number 2, beverages. This one's interesting because it had the slowest revenue growth, only up 5% to 65.4 billion.
So if you just looked at the top line, you might think it's a bit stagnant.
You might, but the profit tells a completely different story. Despite that slow 5% revenue growth, the PBT for beverages surged an impressive 26% to 9.75 billion.
So this is pure margin expansion. This
Yeah.
has to be driven by internal cost control.
Overwhelmingly. It highlights really successful cost reductions and strength in their international markets, which managed to offset some domestic tax headwinds they mentioned.
That's resilience. To grow your profit by over a quarter, even when facing new taxes, shows real management skill.
It really does. Now, the final core segment, oils and fats. This one delivered the highest PBT growth percentage, a staggering 74% jump to 1.83 billion.
On what kind of revenue growth?
A strong 35% increase in revenue, hitting about 43 billion. This segment is clearly in a high-growth, high-leverage phase.
And do we know why? Is there a specific driver?
Yes, and this is crucial. We can connect this growth directly to a quantifiable measure of efficiency, a 13% increase in capacity utilization at their Malaysian plant.
Ah, okay, so they're putting their assets to work.
Exactly. When you increase utilization, you're spreading your fixed cost depreciation, maintenance, over a much higher volume of output. That 13% capacity boost translates directly into better cost absorption and consequently that huge 74% jump in PBT.
So across all three core segments, we see clear structural reasons for that 62% jump in group operating profit. But we should probably touch on the 1 week spot.
Right, the outlier, leisure. It's a small part of the group, but it's important to note.
The numbers there were pretty weak. Revenue dropped sharply to $400 million, and it posted a PBT loss of about $52 million.
Correct. But the report gives a very specific reason for this, the Pegasus Reef refurbishments.
Which is actually reassuring. It frames the loss not as a structural failure, but as a temporary, planned operational issue. It's an investment for the future.
An investment in future pricing power. So it's a drag now, but it should reverse once the upgrades are done. So with that, we've established the operational profit is high quality, but now we have to move to the ultimate reality test.
Cash.
Cash is king. The income statement can be managed, but the cash flow statement tells the absolute truth.
We're moving from accounting profit to actual cash in the bank. And if those two numbers diverge in the wrong direction,
It's a major red flag. But in this case, they diverge in the positive direction, which is the hallmark of a really healthy business.
Okay, so let's get the key figures. We know the profit attributable to equity holders was 10.22 billion rupees.
But the operating cash flow, or OCF, the cash generated before any investing or financing, hit an extremely robust 28.26 billion rupees.
Wow, that is nearly 3 times the reported profit. That's an exceptional gap.
It's phenomenal. It points to superb working capital management. They're collecting cash from customers very quickly, and this overwhelming cash generation basically gives the final stamp of approval on the quality of those earnings we just analyzed.
And this high cash flow leads us directly to what we're calling Lesson 1, the ultimate validation metric.
The cash conversion ratio. This is what separates real profit from phantom profit.
And the number here is 1.17x. Can you explain what that means for our listeners?
Absolutely. A ratio over 1.0 is the gold standard. Think of it this way. If the ratio was, say, 0.8x, it would mean for every rupee of profit they reported, they only collected 80 cents in cash. The other 20 cents is stuck somewhere, maybe in inventory or unpaid customer bills.
But at 1.17x,
At 1.17x, it means every rupee of reported accounting profit is backed by more than a rupee of actual spendable cash. In this case, 1 rupee and 17 cents. It's the ultimate confirmation that the earnings are real, liquid, and not some accounting fiction.
so this high OCF then allows us to calculate the real bottom line for investors, free cash flow.
Right. FCF is the cash left over after the business has covered all its essential investments. It's the money management can actually use for dividends, acquisitions, or paying down debt.
So we take that incredible OCF of 28.26 billion, and we subtract the capital expenditure, or CapEx.
Which stood at 5.36 billion.
And that gives us a free cash flow figure of 22.90 billion rupees.
In just 6 months, that is an absolute river of cash. It tells you their existing assets are highly productive and the business is a cash machine.
So the next logical question is, what did they do with all this cash?
And the report shows clear evidence of financial discipline. They deployed a significant chunk, 6.33 billion, towards debt repayments.
Cleaning up the balance sheet.
Exactly. And they paid out another 2.57 billion as dividends to their non-controlling interests. So, smart, disciplined capital allocation. That debt repayment, in particular, is a perfect segue into our next section.
The balance sheet. If cash flow was the reality test, the balance sheet is where we check for long-term resilience. We're looking for what we call fortress strength.
Let's start with the most basic health check. Liquidity, the current ratio.
Right. Their ability to cover short-term bills, the ratio stands at 2.24x. That's $135.3 billion in current assets versus $60.5 billion in current liabilities.
A ratio of 2.24x is exceptional. Anything over 1.5 is strong. 2.24 is, as the source said, rock-solid liquidity. They have more than double the liquid assets needed to cover all their bills for the next year.
A huge safety buffer. But the true measure of a fortress balance sheet comes from what we call Lesson 3.
Analyzing the debt structure against their cash reserves. This is where you find hidden risks, or in this case, hidden strength.
So let's start with the cash pile. They're sitting on a mountain of cash.
72.43 billion rupees in cash and cash equivalents. A massive amount of dry powder.
And against that, what's the total debt?
Total debt is 68.55 billion. About 17.1 billion of that is short-term, and the rest is long-term.
So this brings us to the critical conclusion about their balance sheet.
The net cash positive status. The cash on hand, that's 72.43 billion, is more than enough to pay off their entire debt load, both short and long-term, and still have cash left over.
So they are, in effect, a debt-free company on a net basis, which is the definition of peak financial strength.
And the strategic flexibility this gives them is just immense. This is lesson 3 in action.
It means they can weather any economic storm, they can pay dividends, they can pursue acquisitions, all without having to dilute shareholders or take on new debt. They have incredible optionality.
And we see this strength reflected in the growth of the company's internal value, the net asset value, or NAV, per share.
The book value.
Right. It rose a phenomenal 17% in just 6 months, climbing from about 646 rupees to 758 rupees.
A huge appreciation in the intrinsic book value of the company. And it's backed by real hard assets. So the balance sheet isn't just solid, it's reinforced steel.
Agreed. So now we can synthesize everything by looking at a few key efficiency ratios that wrap this all up.
Let's do it.
First, the returns. The annualized return on equity, or ROE, stands at 28.5%. For a big conglomerate, anything over 15% is strong. Nearly 30% is just exceptional capital efficiency.
A sign of great management.
And the annualized return on assets, or ROA, is 15.8%. This tells us their entire asset base is working hard and generating very high returns.
And what about the risk?
The risk metrics are just as strong. The interest coverage ratio is a staggering 15.4 times. This means their operating profit is more than 15 times greater than their interest payments.
Which means their financial risk is practically zero.
Minimal. It confirms that net cash positive status. Their debt is trivial relative to their earning power.
Okay, so let's synthesize the true P&L. We started with that headline, 165% profit increase. We can now say with confidence that while it was helped by the FX swing, the profit quality is overwhelmingly real.
It's rooted in deep structural operational improvement.
Right. We saw the margin expansion across plantations, beverages, and oils and fats. But the final, irrefutable proof was the cash.
The 1.17x cash conversion ratio, that's the metric that proves the 10.22 billion in profit is real, liquid, and sustainable.
So our deep dive shows that BUKI is not just financially strong, it is strategically positioned because of its operational discipline and its incredible ability to generate free cash flow. And by the way, if this kind of deep dive is helping you understand how to parse corporate financials, please make sure you like this analysis and subscribe to the channel. Your engagement really helps us keep delivering these detailed breakdowns that go beyond the headlines to find the true P&L.
And if we connect all this to the bigger picture, the group has achieved fortress-like stability. We know they have over 72 billion rupees in cash. We know they're generating nearly 23 billion in free cash flow every 6 months. The engine is robust. The balance sheet is clean.
Which leads to the single most important strategic question for any investor looking at this company's future.
It does. And this is where we shift from analysis to anticipation. Given this massive, consistent capital generation and their net cash positive status, what high-impact strategic move is management planning for the second half of the year?
That's the question. They've solved the problem of making money. Now what do they do with it?
Exactly. They have the war chest to do a transformative M&A deal, a massive share buyback, or a huge strategic expansion. The pressure is now squarely on management to deploy this immense capital efficiently. They can't just let it sit on the balance sheet earning minimal returns. That capital allocation decision is the next major pivot point for the group, and it's what we'll all be watching for.
Thank you for joining the True P&L Deep Dive. We hope this analysis provides you with the knowledge to make informed decisions.
Always remember to conduct your own research. Until next time.